Hello, everyone, and welcome to the Moss Adams on-demand webinar on the CARES Act for individual taxpayers. My name is Alex Nunley. I'm a tax senior manager here at Moss Adams, and today I will be discussing some of the key tax provisions of the CARES Act. The CARES Act was signed into law on March 27th of 2020 to help mitigate some of the adverse financial impacts the COVID-19 pandemic has had on the U.S. economy. The Act includes tax provisions for both individuals and businesses, but today we'll be focusing on the tax provisions applicable to individual taxpayers. First, some housekeeping. The material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including, without limitation, legal, accounting, or investment advice. The first provision we'll be discussing is the change to the treatment of net operating losses. The 2018 tax reform made several changes to the rules regarding net operating losses. Specifically, NOLs generated could no longer be carried back to prior years and were required to be carried forward, and when carried forward could only offset 80% of income. The CARES Act has suspended both of these rules, now allowing NOLs generated during the 2018, 2019, and 2020 tax years to be carried back up to 5 years, and any NOLs carried forward during these tax years will offset 100% of income. Under the CARES Act, certain individuals will be receiving funds for the recovery rebate. Recovery rebate is a $1,200 tax credit available to qualifying individuals and a $2,400 credit for married filing joint couples. The credit is not available to non-resident aliens, individuals that can be claimed as a dependent by another taxpayer, or estates and trusts. In addition, there is a credit for $500 for each qualifying child. The definition of qualifying child for the purposes of this credit is the same as for the child tax credit. The recovery rebate credits are subject to AGI phase-out limitations. The credits will start to phase out once a single filer has AGI over 75,000, a married filing joint couple has AGI over 150,000, and a head of household filer has AGI over 112,500. Note that these thresholds are also applicable to the $500 child credit. The credit is reduced by 5% of the amount of the taxpayer's income that exceeds the AGI threshold. For example, a single taxpayer with no children will be completely phased out of the credit if their AGI is 99,000. Another example, a couple with 2 children and AGI of 218,000 will be completely phased out of all credits, including the $500 per qualifying child credit. Although the recovery rebate is referred to as a credit, it will be refunded in advance. The credit amount will automatically be paid out by the IRS to taxpayers and will be based on the 2019 tax return if filed, or if not filed, the 2018 tax return. Taxpayers will receive the payment for the credit via direct deposit if the direct deposit information is reported on their last tax return. Otherwise, they will receive a check in the mail. The credit will be recalculated on the 2020 tax return based on the taxpayer's 2020 AGI. If it is determined that the rebate was paid in excess of what should have been paid when recalculated on the 2020 tax return, the taxpayer will not need to repay the excess amount. There are also some changes with respect to retirement funds. Individuals that themselves, their spouse, or their dependent were diagnosed with COVID-19 or have had adverse financial consequences due to being laid off, furloughed, or a reduction in hours can take a maximum withdrawal from their retirement fund of $100,000 through December 31st, 2020. The distribution received will be included in income over 3 years, and the 10% early withdrawal penalty will be waived. There are also some changes to the maximum amount one can borrow from their retirement fund. Individuals can now borrow up to $100,000 from their retirement fund, and the repayment rules extend the pay routine for 1 year. Lastly, required minimum distributions are not required for 2020. There are significant updates to the charitable contribution limits and who can take a charitable deduction. Generally, one must have to itemize their deduction to take a deduction for a charitable contribution. However, the CARES Act is allowing taxpayers that don't itemize their deductions to take a $300 above-the-line deduction for a charitable contribution. For taxpayers that do itemize the deduction, the 60% AGI limitation for charitable contributions has been increased to 100%. In order to receive the 100% limitation treatment, the contributions cannot be to a 509(a)(3) supporting organization or a donor-advised fund. So just to illustrate this, let's say we have a taxpayer with AGI of $100,000, and in the current year, they made charitable contributions of $100,000. Before CARES, the taxpayer would only be able to deduct $60,000 of that charitable contribution in the current year, and the remaining $40,000 would be carried forward the next year. But under the CARES Act, all $100,000 of the contribution would be allowed as a deduction in the current year. Our next provision, excess business losses, provides a great opportunity for taxpayers that had business losses that were limited in 2018. Prior to the CARES Act, business losses in excess of $500,000 were not allowed and were converted into an NOL that was required to be carried forward. CARES Act has suspended this rule retroactively back to 2018 and through 2020. If a taxpayer's business losses were limited by this rule in 2018, they can amend their 2018 tax return to allow those losses. If amending the 2018 tax return results in an NOL, the NOL can be carried back under the new rule I discussed back on slide 1. Here are a few additional provisions in the CARES Act for business owners. If you were allocated excess business interest expense in 2019, 50% of that amount can be deducted in 2020, and the remaining 50% will continue to be subject to the original 163J rules. If you are subject to the business interest expense limitation under 163J as an individual, the deductible business interest expense was limited to 30% of adjusted taxable income. Under the CARES Act, the limitation is now 50% of adjusted taxable income for the tax years 2019 and 2020. Next, the qualified improvement property glitch has been corrected. You may recall there being some changes to qualified improvement property last year under tax reform, essentially making it subject to 39-year lives and not qualifying for bonus depreciation. This is something that was acknowledged as an oversight, and many hoped it would get corrected, but it never did until now. Under the CARES Act, qualified improvement property is now assigned a 15-year life and eligible for bonus depreciation. In addition, this is retroactive to 2018, so look for opportunities to amend 2018 returns for this, as the benefits could be substantial given 100% bonus depreciation. One thing to keep in mind is if real property, trade, or business elected out of 163J cannot be subject to the business interest expense limitation, they are required to use ADS lives, which are 20 years for QIP as opposed to 15 years. There are also some updates to the student loan repayment. Employers can now pay up to $5,250 of an employee's student loan debt or educational expenses tax-free during 2020. This brings us to the end. Before I let you go, just a few key takeaways and things to keep in mind. Look for net operating losses in 2018 that can be carried back. Look for opportunities to amend 2018 returns to allow losses previously limited. Adjust depreciation on qualified improvement property for the 15-year lives and bonus depreciation, but like I mentioned before, please be sure to keep in mind if there were real property elections made under 163J, which requires you to use ADS lives. One thing regarding the rebate, consider holding off on filing your 2019 return if based on 2018 AGI, you would qualify for the rebate, but based on 2019 income, you don't. If you don't need to take your required minimum distribution, consider not taking it in 2020. It might help you qualify for the rebate credit in 2020 if you didn't qualify for it in 2019. And lastly, if you end up taking an early withdrawal penalty an early withdrawal from your retirement, consider repaying in 3 years to avoid income inclusion. And that's it. Thank you so much for joining me for this webinar. I hope you all found it helpful. If you have any questions, please don't hesitate to reach out to me. My phone number is 503-478-2243, or you can reach me via email at alexandria.nunley@mossadams.com. Thank you.